Managing a private company can be more beneficial than going public because you have complete control of the operations. However, by going public, you can expand your business quicker and having more access to vast amounts of capital. In this video, we'll look at the key advantages and disadvantages of a company going public on the stock market. So, what happens when a company goes public? Firstly, shareholders will probably hold a meeting to ensure the decision will support everyone's interest. Once the decision has been made, the company's books are reviewed to confirm that they meet the standards. Normally, the process takes a few months, since going public requires the approval of the Securities and Exchange Commission. When everything is good to go, a date for the initial public offering is set. But what is an IPO? When an IPO begins, a company hires an investment bank that can buy their shares in exchange for a lump sum amount of the shares. After that, the investment bank advisors begin sourcing private investors who will buy these shares. The main goal of the banking advisors is to convince investors by presenting information about the company. The presentation often includes financial data and the management structure. Following investor demand, the company must pitch the pricing of the offering and the listing date. Once that is completed, the company requires SEC approval and can then finally be recognized as a public company once shares are officially issued. The banking advisors, also commonly referred to as the underwriters, will continue to stabilize share offerings to minimize share price volatility. In other words, the bank becomes the sole distributor or seller of the shares before it gradually enters the stock market. Once the company has gone public, monitoring the stock share price becomes critical because this will indicate the company's financial outlook. Under favorable circumstances, joining the stock market can help the company generate capital instead of relying on creditors. Not only that, but shareholders can also make it big once the stock price increases while executive salaries increase. The next advantage of going public is having the capacity to repurchase shares, which is also known as stock buyback. This can be an effective way to control the shares during a stock market flotation. By repurchasing shares and turning them into treasury shares, stakeholders regain ownership of the business. Plus, these treasury shares can just be resold again at a time when the stock share price is higher. Repurchasing shares is an advantage because reducing the number of shares in the market allows the company to control the stock price to a certain extent. If limiting available shares increases the stock price, new shares can be issued accordingly to raise capital. However, this is only an ideal move at a time when shares are priced at a higher value than they're worth. But how exactly is making new shares beneficial to the company? To reiterate, having new shares that cost more than the IPO price opens a chance for the company to get into equity financing. This means funds are generated because the earnings per share have increased. Such a situation will attract investors as they acknowledge the potential benefits of buying shares. The production of new shares means that a shareholder's ownership within the company decreases as the total number of shares has increased. This refers to share dilution, which may seem disadvantageous, but this is only detrimental if the worth of your shares decreases. To maximize profits, companies should make sure that the issuing new shares and repurchasing stocks are done strategically. Meanwhile, going public also means greater exposure to the public eye, especially if company shares maintain a high price. This will attract more investors and leave a positive impression on equity analysts. With such consistency, the company can further build trust with the shareholders and private investors from the positive coverage from the media. While the opportunity to increase profits and make it big is present when joining the stock market, it's critical to be strategic to avoid major losses. After all, having more investors means having limited control over the company, and there will be factors that are out of your control. The first major disadvantage of going public is the volatility of stock share prices, as significant market fluctuations are common. If the CEO or shareholders don't know how to strategize the buying and selling of stocks, there's a high tendency that the company will suffer financially. An example of this would be stock buybacks at a higher price than what you sold it for. Greater publicity is another disadvantage if you prefer working outside the spotlight with less regulatory requirements. That's why before making your company public, you must know that everything about the company will need to be transparent. Aside from the accounting and SEC requirements, people who have bought shares will also require transparency. Transforming your company into a public one means that you're less likely to have privacy regarding future plans. It doesn't also end with the requirements submitted, since being on the stock market means following regulations that the company didn't follow previously. Speaking of being regulated, this leads us to the fourth disadvantage of going public. You see, with public companies, anyone who has chosen to buy your stock shares is already an investor. How your company performs will immediately impact them financially. Therefore, you'll feel the pressure when investors withdraw because they have lost confidence in the stock. Public companies are left with the need to prove themselves by providing both short-term and long-term results. There will also be more pressure to succeed as new investors put in their money with a greater desire for short-term results over long-term performance, and it doesn't really help when they're impatient. If the pressure gets to the company management, it may take a toll on the financial performance while investors protect themselves by selling shares to minimize losses. The worst-case scenario is losing investors and failing to pay the creditors who provided the loan. The company's original founders will likely experience less control in the future of the company as new shareholders have a say in decisions. Most of the time, the company's original founders are the most passionate people in the organization. Therefore, reducing their power can slow down growth. Additionally, a greater emphasis on pleasing short-term shareholder demands may mean the company is diverting away from long-term objectives. Check out this video for tips on calculating the value of a stock. Also, please consider subscribing and clicking that like button because it helps. Cheers!